Yo, what's going on, everyone? So today I'm going to be talking about what is the stock market. So this video is going to be about those who don't know about it, those who want to learn. I know it's been popping off for a while now, so I want to teach you guys so you guys can have a better understanding of how it works and whatnot. So let's jump right in. All right, so for starters, what is the stock market? The stock market is a place where people buy and sell small pieces of companies called shares. So the market opens from 9:30 a.m. to 4 p.m. Eastern Time. They call it a pre-market, which is before the market opens, 4 a.m. to 9:30 a.m. Eastern Time. And then after hours, which is after the market closes, it starts at 4 p.m. to 8 p.m. Eastern Time, and then it's always closed on weekends and holidays. You kind of think about it like Facebook Marketplace. People go on there, they buy stuff, they sell stuff. It's kind of like that, but with shares instead of products. Alright, so how does it work, right? So we're gonna say that this lemonade stand is your business and you're selling lemonade. So you want to grow your company, right? So you're gonna need money. So one thing that companies like to do is they like to call for investors. It's kind of like Shark Tank. If you've seen Shark Tank, people go up there, they pitch their business and try to get an investor on their side so they could grow their company, using their money in exchange for ownership in their company. So now back to the lemonade stand. Let's say that you want to grow and you want multiple lemonade stands in different blocks. So you could reach more potential customers and get more sales, etc. So what you do is you sell a piece of your company into the stock market for money. So now you just raised the money that you needed, and then your company is publicly trading in the stock market. So now that you got your money, your company will be publicly traded. So your initial stock price is determined by your company's valuation. So it's not random, right? And it all depends on like the number of shares you sell, investor demand, market conditions, and then the pricing decisions made by investment banks during the initial public offering process. So it's not random. You don't just get to choose your stock price, but it also depends a lot on your company, right? So your stock price is going to go up and down based on supply and demand, right? So if your company is selling very good lemonade and people think that, yeah, this lemonade is going to be the best in the world, it might be in the store someday, people might buy. They might buy the stock, and it's a happy day for you because your stock is going up. More investors are seeing that, they're seeing the growth, more people try to invest, and your company grows. Now if your lemonade is not that good, let me tell you, your price will drop, and investors will see that people who are in there might, get out. So, but it's also a good indication, like, okay, I gotta work on my lemonade, see what I can improve, etc. And another thing that could drive my stock price to go up is if I put out news, right? So if I come out with a new flavor and I put that as, big time news, more people might buy because they might think that, oh shoot, this company's coming out with new flavors. Everything is good. This company has potential to keep growing, so I'm gonna just buy the stock. So now we're gonna get into some essential vocabulary that you'll definitely see at some point. Whether you're trading or you're looking at financial reports, you're gonna see a lot of these words. So the first one is IPO, or initial public offering, and this will be the first time a company sells shares to the public. So once a company goes public, that's their initial public offering. So the next thing is a second offering. And this is when a company issues more shares after the IPO to raise even more money, right? So you can do a second offering after the first one. So next we got buyback, and that's when a company buys its own shares from the market. So the lemonade stand, right? I sold some of my shares to the market to raise money. Now I'm buying it back. You could also do that. Next, we got market capitalization, and this is the total value of a company's shares. So I put the formula up there so you could get a better understanding. It's the stock price times the total shares. We're going to touch base on that a little more later. So next we got dividends, and these are cash payments a company gives to shareholders from profits. So let's say the lemonade stand made profits, and I want to give something back to my investors for holding the stock. So that would be a dividend. Now these cash payments are not that much. Right? It's probably a couple cents. Some give like $1. So you got to also do research on what companies give out dividends. There's a lot of people that just base their portfolio off of dividends, which is like they just own companies that pay them money, which is really good. But you also got to look at financials, make sure it's a good company that you invest in. So next you got liquidity, and this is how easy it is to buy or sell a stock without affecting the price too much. So more liquidity means it's easier to get in and out, right? So if you're day trading, for example, that's when you buy and sell a stock in the same day. You want liquidity because it's really easy to buy and sell a stock. If you have no liquidity, it's going to be tough to get in and out very quickly, or you won't get, the desired price that you would like. So next we got shares, which is just pieces of ownership in a company. So now let's talk about trading versus investing, right? Because they are different things. Right? So day trading is when you're buy and sell in the same day. So if I place a trade right now at 5 o'clock and I sell at 5:05, that would be considered a day trade. Swing trading is a little bit different. You hold it overnight, right? So swing trading can vary. So I could swing trade from today. So let's say I place a trade today. Today's Tuesday. Once I sell on Wednesday, that's a swing trade. If I hold it overnight, it's a swing trade no matter what. So I could sell Wednesday, I could sell next year, next week, whatever. That would be considered a swing trade as long as I'm holding it overnight. And then investing is when you're long-term buying. So I buy today to, you know, just keep growing the account and potentially sell in a couple years, right? So next we got stock split, and this is when a company increases the number of shares but lowers the price per share. So this makes the stock more affordable without changing the total value. So let's say a company is worth $600 at this moment. They will do what's called a stock split, and now they just made the company more affordable. So they're increasing the shares in order to make the price go down, but the value still remains the same. So let me give you a quick example of what that looks like, right? So let's say a company, right? Remember, I said the market cap equals the stock price times the number of shares. So let's say one company has 1 million shares and is priced at $100 each, right? So that has a 100 million market cap. That's what they're worth. That's their valuation, right? So then what they can do is they increase the shares, let's say 100 million shares, and now the price of the stock is $1 each. It still has the 100 million market cap valuation, but now it's much more affordable for people to buy. So now if the company goes back to $100 a share, then what's going to happen is you're going to have less shares, but the same amount of value. Alright, so next we got volatility, and this is how much the stock price moves up and down over time. So the more volatile, the more risk and more potential profit. So basically how fast or how slow the stock moves on a day-to-day basis, right? So something like Apple, right, will move pretty fast, right? Because it's very volatile. A lot of people are trading it. But something, let's say like Ford, right? It doesn't move too much, and I'll show a chart up on the screen. It doesn't move. It doesn't have too much volatility. So it depends a lot on your investment goals, right? So if you just want to buy and hold for a long time and you don't want to have that volatility, then you will buy a stock that doesn't move too much. Now, if you do want volatility so you could profit from that, then you will look for a stock that moves a lot faster. So now, last but not least, you may have heard of these. It's a bull and a bear. So when you're considered a bull, you're someone who believes the stock will go up. And if you're considered a bear, you're someone who believes the stock will go down. So typically people associate this with green and red, right? A bull attacks up, So that's when the price is going up. A bear attacks down, that's when the price is going down. So if you think about it like that, um, these terms are used a lot when it comes to the stock market. So it's very important to remember. So now I put up on screen different market caps, and it all depends on the valuation of the company, right? So for example, large cap are companies valued at 10 billion and up. So this would be something like Apple, Amazon, Microsoft. Something that's considered mid cap are growing companies. So 2 billion to 10 billion. Small caps are 300 million to 2 billion. Micro cap is 50 million to 300 million, and then nano cap is under 50 million. So I put it on there so you guys can have a little more perspective of what these all mean and what they look like. Okay, so now I'm going to talk about some common questions that I see all the time. And if you guys have more questions, just leave it in the comments and I'll answer you guys. So the first question is, how do companies determine how many shares their company is made up of? So companies can determine whatever shares they want, but they also just got to keep in mind, okay, if I have too many shares in the market, I have a lot of supply, right? And if there's demand and you have a lot of supply, your company is too easily accessible, right? But if you have a lot more people trading your stock demand and you have less supply, then a lot of people will see the worth of buying and holding your stock for a long time, right? So, for example, let's say you have 100,000 people trading your company and you only put out, let's say, 50,000 shares. That means you have more demand than supply. So, hence, if people are trading it, let's say you put out some good news and your stock price is going up, a lot more people are more likely to trade it. A lot more people are more likely to buy and hold. So those are just things to consider. But when it comes to the shares, yeah, you could pretty much do as many shares as you like. So the next question is, why do companies care about the stock price? Now, people ask this because once you sold your shares to the market, the company doesn't make more money. So the stock price could go up $100 and the company makes no money from that because they already sold their shares. So unless the owner has bought shares from the market, then they won't benefit from that stock, going up. So why do companies even care about it in the first place? Right? So it's a lot about, perception and reputation, right? If you have a stock price that's really high, you could be considered a valuable company, right? Let's look at Apple, let's look at Microsoft, Nvidia, Tesla, right? These are all companies that have high stock prices, so they're considered very valuable. And if the stock price falls, it can hurt your credibility, and you also got investor pressure. And what a lot of companies also do is that they give employee incentives in the form of stocks, right? So you can't just give your employees some stocks if your stock sucks, you gotta maintain it, you gotta keep it up. Now, another reason why they care is if they need to raise more capital in the future, right? So a higher stock price means that they could raise more money without giving away as much ownership. So the next question is, how do people actually make money? Well, people make money by buying a stock at a certain price, let's say $4, and selling it at $4.10. So you just made a 10-cent spread, right? So depending on how many shares you buy, that's how much money you'll make, right? So obviously always use caution when you're trading, especially volatile stocks, because these stocks can go up and down very, very quickly. Now, if you were to sell at $3.90, you will also lose that 10-cent spread. So, it works both ways, essentially. So next question, is the stock market gambling? It is definitely not gambling, but there can be gambling. So if you're just going in and just taking trades just to make money and, you don't really care about any analysis whatsoever, then yeah, of course it's gambling. You're better off going to the casino and putting everything on red, but at least they tell you right away whether you made money or not. But if you have a strategy, you're following certain patterns in the market, even for long-term investing, if you if you read financials and you look at a good company and you know why you're investing, then no, it's not gambling. And a lot of people who say are gambling are the ones actually gambling. So you got to be careful of who you listen to. So now, a good question is, what's the safest way to start? I think the best way to start, if you're swing trading and you're day trading, go in a simulator. There's a lot of companies, brokerages now that offer a simulator. It's all free. It's simulated money, so you don't actually lose or win anything, but it's good practice. Now, if you're long-term investing, you just got to do your due diligence on the ETF or stock that you're buying. And you can start as little as $1, so you don't need to invest too much. So now I wanted to address some common phrases that I hear all the time that I don't particularly agree with. So the first one, don't buy the item, buy the stock. Now, I gotta put this as a disclaimer. If you don't know how to invest, don't do this. Right? You're not gonna make as much money as people say when instead of buying Starbucks a $5 cup of coffee, I don't know if it's $5 no more. If you put it in the stock, you're not really making that much returns back. I'm just saying, right? You're gonna need a lot of money to get decent returns back from said company, right? And if you invest in a bad company, it could really mess you up in the long run. As always, do your due diligence. This only works if you understand the business, the valuation, and the risk. It's not just because you like the product. Another phrase that I'm hearing all the time. Yo, trust me, bro. Buy this stock. No, no, absolutely not. Do your own due diligence and analysis before you buy. Do not blindly follow someone else without understanding your reasoning for entering a trade, right? Maybe that person can be right, but as long as you understand why you're getting in, then you can take a position, right? Don't just blindly get in because a lot of these people don't know what they're doing, or they got it from somebody else who got it. It can get messy, man. And once you lose money, you're not gonna look at them the same, right? So make sure you do your own due diligence. If you do want to copy somebody, which I don't recommend, but if you do, at least understand why you're doing it and the potential risk that it brings as well. So yeah, that's gonna wrap up today's video. A couple side things I wanted to talk about. The stock market isn't a get rich quick scheme. I know a lot of people are putting it out there that you could make $10,000 a month, yada yada yada. That's all scam, man. It's all BS. Don't don't listen to these people, man. It's not a get rich quick scheme. If you do get rich, think about it. If you make 100,000 in a day, you can also lose 100,000 in a day, right? If you make 100,000 over time, it's harder to lose 100,000 over time, right? So it's not a get rich quick scheme. Don't try to just rush and make money like these gurus and stuff. It's not worth it. Now, next, you can start investing with as little as $1, right? So brokerages like Robinhood or Webull, they have fractional shares, so you don't even gotta buy a full share. You could just put in $1 in whatever stock you want, and you could just start investing like that, right? Now, before doing anything, educate yourself first. Start small and stay consistent, right? You can't be a doctor without going to school, right? You can't be a teacher without learning about what you're about to teach. So, educate yourself, start small. Like I said, you could start investing as little as $1. If you're day trading, swing trading, you got simulated trading, and just stay consistent. It's all about staying consistent. The stock market trading is not as hard as people make it seem to be. It's really just a battle against yourself. But if you stay consistent and you start small, everything will be better in the long run. And think about it, if you can't make money or invest with small amount of money, you can't do it with big amount of money. So that's another thing to keep in mind. But yeah, I appreciate anybody who watched the video in full. I have more videos coming out soon, and I appreciate your time. Thank you.